Welcome to China Expert Series from China Asset Management Hong Kong. I'm your host Lorena. Today we are joined by Raymond, one of our China expert and star portfolio manager. We will decode the macro setup, map out catalysts for H-share and A-share equities, and translate it all into practical ETF positioning. Raymond, great to have you.
Thank you for having me here.
Let's set the macro table first. The market is pricing a high probability of an upcoming Fed cut. Do you think conditions are now in place for a durable bull market in H-shares?
Yeah, we think the foundations are taking shape. On valuation, the Hang Seng Index trades around 12 times PE multiples and 1.2 PB, about the 10-year median. While if you look at the US market, S&P 500 sits near around 28 PE, implying over 60% discount from its shares. On liquidity, Southbound inflows have exceeded Hong Kong dollar 900 billion year to date, and we've seen overseas participation recover with high turnover. Combine inexpensive valuations with looser liquidity, and we think a classic double play is in place to support the long-term bull market for H shares.
So easing is coming. Let's move to flow and market structure. People always compare H-share to A-shares, and we've seen Hong Kong outperform A-share this year. What are the drivers, and is it mainly southbound flows?
Yeah, the DeepSeek moment in February helped reset China's innovation narrative. H-shares that benefit from deeper liquidity and expected sharp decline in hybrid into this year, a lower valuation, higher dividends, and a heavier mix of tech, internet, and innovative pharma areas have been seeing valuation repair. So in a domestic asset shortage environment, I think the institutional investors favor Hong Kong's combination of value and yield. We think southbound inflows can continue and potentially set a new full-year record as inactive funds and insurers remain underallocated.
So what's foreign investors' view on China now? Are they coming back to Hong Kong? And is this a classical bull market, or is it just a water buffalo phase?
Good question. I think foreign investors they have interest in onshore A-shares, and investors are looking for confirmation that we call deflation pressures are still fading and growth is re-accelerating via PPI, core CPI, corporate profits, employment, and the consumption share of GDP. A water buffalo dynamic where both bonds and equity rise on liquidity can emerge under sustained easing and improving inflation. So for durability, fundamentals must follow. Multiples can move first, but earnings need to catch up. Yeah.
We also noticed that the AH premium is narrowing. What's behind this, and which sector look attractive now?
Yeah, the AH premium has tightened due to low valuations, high dividends, and the relative ease of incremental state building, especially insurers increasing allocations to A-share like banks, and that make up 35% of the AH index. We currently prefer growth to sectors such as Hang Seng Tech and Hong Kong Biotech because their elasticity is higher with more room to run as sentiment heals and liquidity remains supported. For example, the Hang Seng Tech Index 4 PE ratio is around 11 times and below its historical median. That will leave some room for mean reversion.
For A-share allocation tools, investors often look at the CSI 300, the most representative A-share index. Within CSI 300, the top three sectors are financials, consumer, and tech. What's our view on this into the year end?
For each different sector, we have different preferences. For example, in financials, we prefer non-bank brokers and insurers over banks. July data shows that M1 beating expectations and the M1 minus M2 such kind of gap narrowing, which signals stabilization. A looser backdrop will support multiple repair for brokers and insurance. And for consumption, earnings are still tied to macro momentum. The recovery is modest, because we can see that the GDP is improving but not accelerating. So retail sales haven't broken out, so it is a stock pickers space right now. And for tech, actually the sector benefit from technology advancement, industrial upgrading, and new productive forces. So we see significant midterm potential across the ecosystem.
Tech is central, but Hang Seng Tech Index has been consolidating with mixed sentiment. What could catalyze the next leg?
We see 4 layers of catalysts. The first is the macro and the policy. If the Fed cuts in September, foreign capital could re-risk into the emerging market. That will help the valuation repair in Hong Kong tech. Domestically, stronger than expected fiscal support like tax incentives and the industry programs will lift earnings expectations and confidence. And the second, industry structure and regulation. We call the anti-evolution measures. So if regulators temper hyper competition areas like food delivery and e-commerce could end subsidy wars. So that will restore margins for leaders and refocus capital on innovation that will drive the multiple expansion. The third, interim result in August. So if leading tech companies deliver upside versus expectations, that will be a clear signal for capital to re-enter. And the last one, innovation cycle, the AI DC stack, compute, data centers, multimodal AI, continues to see high growth, creating medium to longer term structural opportunities.
Let's address healthcare after its big reset. Is this an entry point for Hong Kong biotech, and how should investors approach it?
First, China biotech sector is still cheap, and despite this year's very good rebound, well, Chinese innovators' pipelines and commercialization have materially improved since 2021. Global validation is strong. We saw that about 40% of the US pharma BD deals this year targeted Chinese biotech companies, yet Chinese innovators trade at significantly lower valuation than US peers. So that will create an attractive asymmetry. Versus other innovation trades like semis, we all know that where China lacks yet often trade at richer PB ratio or PE ratio, biotech offers stronger science at discounted multiples. Yeah.
For investors looking to implement these views with precision and liquidity, please consider these China AMC Hong Kong ETFs. For broad onshore quality and sector balance, China AMC CSI 300 Index ETF 3188, the largest and most liquid offshore CSI 300 ETF. For a cost-efficient A-share allocation with balanced sector exposure and a tilt to the new economy, China AMC MSCI China A50 Connect ETF 2839. For structural tech leadership with valuation support and strong tracking, China AMC Hang Seng Tech Index ETF 3088. For targeted exposure to innovation in healthcare, China AMC Hang Seng Biotech ETF 3069. This is the end of our China Expert series. Raymond, thanks again.
谢谢。
If you find this helpful, please like, subscribe, and share. Drop your questions in comments. We will address them in future episodes. For more detailed product information, please visit ChinaAMC.com.HK. This is China Expert series from China Asset Management Hong Kong. Thanks for watching and see you next time.